Good morning and welcome to Bulls, Bears, and the Bell Weekend Edition. It is November 1st, 2025. And today we're doing our deep dive, but maybe a bit differently. We're not just recapping last week. We're aiming to give you a full strategic playbook because the week ahead, November 3rd to the 7th, looks incredibly volatile. High stakes. If you just glance at the headlines, you'd think we're in market paradise. The S&P 500, the NASDAQ, bona fide record highs. Looks amazing. But when you actually look underneath those big index numbers, the foundation, it feels less like solid rock and, frankly, more like shifting sand. So our mission today is to really dig into the source material, the detailed market reports, the Fed transcripts, what companies actually said in their earnings calls. We want to give you a crystal clear view of that underlying instability and, maybe most importantly, how you can think about navigating it strategically this coming week.
Yeah, and that instability, it's not just random noise. It's really being driven by two very powerful conflicts that sort of solidified at the end of last week and are definitely going to set the tone for this week. First, the market closed out Friday, really defined by what we're calling the great divergence in tech earnings. It feels like investor sentiment just fundamentally shifted. It's no longer about rewarding AI promises. It's about demanding immediate, tangible AI profits, like right now. But the second conflict, and this one has, I think, deeper systemic implications for really every investor, is what the Federal Reserve did. We're calling it the hawkish cut. Sounds contradictory, right?
The hawkish cut. Yeah, explain that one.
Well, the Fed gave the market the rate reduction it wanted, but then Chair Powell immediately followed up with rhetoric that, honestly, created profound and immediate uncertainty about where rates go next. So that combination, it's created this really precarious, top-heavy rally. Our goal today is to unpack exactly how the incoming economic data, which is going to be amplified because of the shutdown and specific tech earnings reports, how they're going to test the very fragile structure of this market over the next 5 trading days.
Okay, let's start with the good news then, because, there are some fantastic headline numbers from the week ending October 31st. Major indices push right into record territory. The S&P 500 had closed the week up, 0.7%, pretty solid. And that locked in its third winning week in a row.
Yeah, and even more impressive, that move secured its 6th straight winning month. That's a streak we haven't actually seen since that big bullish run back in 2021.
Right, so 6 months straight up for the S&P.
And not really a surprise here, technology was the main engine. The tech-heavy NASDAQ composite, it just led the charge, rose 2.2% for the week, way ahead of everything else. The Dow Jones Industrial Average also managed a decent gain, about 0.8%. So if you just look at the surface, the tape looks great, perfectly constructive, technically bullish, almost like it can't be stopped.
But there's always a but, isn't there? The source material, the underlying data, it seems to be screaming a warning. And it really hinges on how narrow this advance is. This is where you need to talk about that crucial warning sign, the non-confirmation alarm you called it. Tells us this rally might have a structural flaw.
It is the most dangerous aspect of the current market, in my view. You have the S&P 500, the Dow, the NASDAQ, all hitting fresh record highs. Great. But one absolutely crucial index did not.
Which one?
The small cap Russell 2000, the RUT. It tracks all those smaller, more domestically focused companies. Instead of rising with the tide, the Russell 2000 actually fell 1.4% for the week.
Fell 1.4%. While the S&P is hitting all-time highs, that doesn't feel right. That feels like a fundamental disagreement within the market about the economy's health.
It's a textbook sign of an unstable market structure. And it tells you a lot about where the big money, the institutional capital, is really placing its bets, or maybe hedging its bets. Think about what the Russell 2000 represents. These are smaller companies, right? Often more leveraged, more dependent on easy credit conditions. They're deeply tied to the U.S. consumer, local spending. So when the RUT fails to confirm the mega cap advance, it means investors are, frankly, deeply concerned about the underlying economic health. They're worried about domestic credit risks.
So this isn't broad-based optimism driving everything up?
No, not at all. This looks much more like institutional capital playing defense. They're flowing into just a handful of huge, liquid, supposedly safe mega-cap stocks. You know the names. The Apples, the Amazons, the Microsofts. They're basically hiding in the companies with the biggest balance sheets.
And we have data on that concentration.
We do. It really highlights the risk. Despite the overall Russell 3000 index, that's a broader index, being up about 15% year to date, roughly half of the companies in that index are still actually down for the year.
Half. Wow.
Yeah. Half are down, even though the index is up 15%. That shows you the concentration. So this defensiveness, hiding in just a few names, it makes the entire market highly vulnerable. If there's any shock or weakness in just those few key stocks, well, The whole thing could wobble. We are dangerously top-heavy right now.
Okay, so we've got this fragile structure.
Yeah.
And that fragility was tested immediately last week by, as you said, two monumental shocks. Let's tackle the first one, Section 2.1. You called it the Great Tech Divergence. The market's been riding this, AI mania for months. But the latest earnings from the biggest tech players, they showed a sudden, sharp, almost violent split between winners and losers.
Yeah, this might be the biggest fundamental paradigm shift we've seen in tech all year. It feels like we've abruptly moved away from rewarding, visionary promises or future potential and moved towards punishing anything that doesn't show concrete, immediate returns directly tied to AI monetization. The reaction to the Fab 5 earnings was completely bifurcated, split right down the middle.
Okay, so who are the winners? The haves, as you put it.
Right, the haves. Let's look at the bullish catalysts first. The reason the indexes managed to rally into the end of the week was almost entirely down to Amazon. Their earnings were a blockbuster. Shares surged, 9.6% up to 12% at one point, all-time high. Now, why am...
Just people ordering stuff online, I assume.
No, the core driver wasn't just retail. It was the incredible 20% year-over-year jump in Amazon Web Services revenue, AWS. That's actually the fastest growth pace they've reported since the peak of the cloud boom back in 2022.
Okay, so Amazon won because it wasn't just talking about AI. It showed real proof of AI monetization through its cloud business. It linked that growth directly to AI adoption by its big corporate customers. It was actual cash flow, not just a future story.
Exactly. They are getting paid now. That's the key. Apple was the other kind of winner under this new playbook. Apple topped estimates and, crucially, they forecasted record holiday quarter revenue. So that proved their core business iPhones, services, it's still really robust. And the market rewarded that because you need that core strength, that cash flow, to actually fund the massive R&D needed for future AI integration. They proved they could fund the future without hurting the present.
Okay, makes sense. Now let's contrast that with the bearish drags, the have-nots. This is where the shock value came in, right?
So this is where the market got, frankly, violent.
Yeah.
Meta Platforms, Facebook's parent company, despite reporting pretty decent quarterly numbers overall, the stock plunged a brutal 11% in just one trading session.
11%. Ouch. What drove that?
Well, the source material, the analyst reports we looked at, they show the reaction was almost entirely centered on just one line item. Meta announced significant increases in planned CapEx spending. Capital expenditures. Basically, they said they're going to spend a lot more money to fund future AI infrastructure. Analysts figured it was a jump of roughly maybe $3 billion over what they previously expected.
So wait, Meta got punished for investing heavily in AI. Isn't that what you expect them to do?
You'd think so, right. But they were punished because the market just violently rejected that investment. One key analyst report called it an expensive promise. The market basically said, look, by diverting too much current cash flow into this long-term project, you failed the new monetization test. Investors are saying, I am not going to fund your future vision if it sacrifices your current profitability. It signals that the era of just blindly trusting big CapEx spending is, well, it seems to be over. Yeah. And even Microsoft, they took a 3% hit despite strong earnings. Why? Simply because their results failed to clear what analysts were calling stratospheric expectations. They basically got punished for not being absolutely perfect.
So the big takeaway here for you, the listener, seems really fundamental. The market's lens, how it values these companies, it has structurally shifted. It's moved away from rewarding AI hype and towards demanding profit versus promise. And we need to carry that lens, that perspective forward for the rest of the week, especially when we look at some of the other tech names reporting.
Absolutely critical. It's the new playbook.
Okay, shifting gears a bit, let's talk macro. The big event was obviously the Federal Open Market Committee meeting, the FOMC. As expected, the committee cut the benchmark rate by 25 basis points, 0.25%. That takes the target range down to 3.75% to 4.00%. Our sources suggest this easing was, partly a nod to some weakening data we'd seen. Specifically, consumer confidence had just fallen to a 6-month low.
Right. The cut itself, honestly, it was largely priced in. It was expected. So, in a way, it was secondary. What really matters, what has the bigger systemic impact, is Fed Chair Powell's press conference after the decision. His rhetoric. This is why we're calling it the hawkish cut. It sounds like an oxymoron, I know.
Yeah, it does. Give with one hand, take with the other.
Kind of. Powell basically threw a bucket of cold water on the easing action almost immediately. It was like giving a gift but attaching a poison pill. He specifically warned that a December rate cut is, and I'm quoting here, not a foregone conclusion. Far from it. That one line. It just completely reset the market's entire perception of risk and policy stability going forward.
Okay, far from it. How quickly did that uncertainty actually hit the markets? Did we see a reaction?
Instantly
Yeah.
and dramatically. The repricing was, frankly, shocking. Just before the meeting, the market odds, the probability of the Fed doing another 25 basis point cut in December, it stood at a very confident 95%, almost baked in.
95%, okay.
After Powell spoke, stressing that everything depends on the incoming data, maintaining that sort of hawkish bias, that probability plunged all the way down to just 63%.
Wow, from 95 to 63, just based on his words.
Just like that. The confidence that the hiking cycle was definitively over and that the easing cycle was just automatically beginning. Completely shattered. Gone. And the most direct consequence, where you saw it most clearly, was in the bond market. Treasury yields normally fall on a rate cut, right? Because bond traders price in more future easing.
Right.
This time. They reverse sharply higher. The benchmark 10-year Treasury yield, which, as we'll discuss, is probably the most important single variable for valuing tech stocks right now, it rose nearly 10 basis points just week over week, hit a 3-week high of 4.11%. So the Fed, just through its words, effectively invalidated its own easing action. By creating this cloud, this lack of clarity about December, the Fed has dramatically increased market risk. And it's increased the market sensitivity to every single piece of incoming economic data.
That's fascinating. And you mentioned the committee itself wasn't unified. There was dissent. What did the source material tell us about that?
Yeah, it was a visible sign of disagreement right on the surface. The final vote on the cut wasn't unanimous. There were 2 dissents. That signals a genuine lack of consensus within the FOMC about the right path forward. The dissenting members' reports suggest they were arguing for either no cut at all or maybe a much softer forward guidance, less hawkish. They represent the faction inside the Fed that still sees inflation as structurally sticky. They worry that easing now will just force the Fed to have to hike again later down the road. So this division, this split within the committee itself, it just adds another layer of unreliability to any future guidance they might issue. It makes it harder to trust what they say.
Okay, so this brings us right to the unique challenge for the week ahead, November 3rd to 7th. We have this technically bullish market, but as we've established, it's fundamentally fragile. It's facing an uncertain Fed policy, and now, apparently, we're running blind. The source material highlights that the ongoing government shutdown is creating a severe data vacuum. What does it mean exactly?
It means volatility is likely going to be amplified dramatically, and that's really what you, the listener, need to prepare for this week. Because the government shutdown is dragging on, key official economic data reports, the ones from the Bureau of Labor Statistics, BLS, the Bureau of Economic Analysis, BEA, they are highly likely to be delayed. The biggest victim here is almost certainly the non-farm payrolls report, the jobs report. Usually that's the single most important monthly indicator for the labor market and therefore for the Fed.
So no official jobs report this Friday.
Highly unlikely, which means investors are forced to essentially fly blind. They don't have the usual government-supplied dashboard, which is considered the gold standard for economic data. And when that happens, when you lose the main report, the importance of normally secondary private sector reports gets elevated, hugely elevated, to primary market moving status. This means the market reaction to the private sector proxies, we're talking specifically about the ISM Purchasing Managers Index reports and the ADP Employment Report, that reaction is going to be significantly amplified. A slight miss or beat on these reports, something that might normally cause a ripple. This week, it could trigger an outsized, maybe even violent index movement, much bigger than usual.
Right, so a huge information gap right when we need clarity the most. And this lack of clarity, you're saying it feeds directly into this perverse market logic that's currently in effect. Hashtag tag 3.1, the bad news is good news regime.
That's absolutely right. The core of this logic, it ties right back to Powell's hawkish cut. Think about it. What's the only thing strong enough now to force Chair Powell to walk back that hawkish pivot, to make him sound more dovish again?
More bad news.
Exactly. Clear, unambiguous evidence of a rapidly cooling economy, maybe even a weakening one. That's the only thing that can reliably send the 10-year yield back down and restore momentum to that fragile tech rally. Because if the economy stays hot, right, if the data comes in strong, well, that just validates Powell's caution. Yields likely climb higher, and this top-heavy rally probably breaks. But if the economy shows real signs of distress, Then the Fed is forced to cut rates sooner, maybe deeper. Yield would likely fall dramatically. And equities, especially those high-growth tech stocks, they soar because capital gets cheaper. So the market is now actively rooting for bad economic news. It's truly perverse psychology. Bad news is good news for stocks right now.
Okay, that's counterintuitive, but makes sense in this context. So let's define the rules of the road for the listener this week. How should you interpret these amplified reports under this perverse logic?
Okay, let's break it down. Logic rule 1. This is the bullish trigger. Weak data is bullish for equities. So if we see a big miss on that ADP employment report on Wednesday, or if the ISM reports show manufacturing and services dipping deeper into contraction, that means the economy is cooling fast. That instantly raises the odds of a December Fed cut back towards certainty, and that sends Treasury yields lower. Result, stocks rally aggressively.
Okay, weak data is good for stocks. Got it. What's the opposite?
Logic rule 2, the bearish trigger. Strong data is bearish for equities. So a surprisingly hot ISM report, maybe confirming strong business activity, or even worse, persistent pricing power. That validates Powell's hawkishness. It validates those two dissenting FOMC members who wanted to hold off on cuts. That sends the 10-year yield decisively higher, potentially breaking the back of those rate-sensitive tech stocks. Result, stocks likely get crushed.
Understanding this inverse psychology really makes the calendar for the week absolutely critical then. These data points are going to be potential landmines, or maybe launch pads. Highly volatile moments.
They absolutely will be. Let's pinpoint them. Monday, November 3rd. At 10:00 a.m. Eastern Time, we get the ISM Manufacturing PMI. This is the first major test of the week. Analysts are generally looking for readings slightly below 50. Remember, 50 is the line between growth and contraction, so a strong number here. Anything significantly above 50 would likely be highly bearish for stocks because it suggests the manufacturing sector is holding up and the Fed might need to keep rates higher for longer or, the terrifying thought, maybe even hike again.
Okay, so watch manufacturing PMI on Monday. Then Wednesday looks packed.
Wednesday is like a data doubleheader. At 8:15 a.m. Eastern Time, we get the ADP employment change. As we said, this is effectively the week's unofficial jobs report because the official one is likely delayed. The consensus estimate is for about 35,000 jobs added. That's a slight improvement from the prior reading, which was actually negative 32,000.
So a low bar.
A very low bar, which means a significant miss here, say, a number close to zero or negative again, that would be very bullish for the market. It would scream that the labor market, which is the Fed's primary focus, is finally cracking under the weight of higher rates.
Right. Bad news for jobs, good news for stocks.
Exactly. But then, just 90 minutes later, at 10:00 a.m. Eastern Time on Wednesday, November 5th, we get the ISM Services PMI.
And services are arguably more important these days.
Arguably much more important than manufacturing. Services make up, 70% of the U.S. economy, and they've been the primary driver of that sticky, persistent inflation the Fed is fighting. So scrutiny here will be intense, particularly on the prices paid subcomponent within the report. If that subcomponent shows continued high pricing power, meaning service companies are still successfully raising prices and consumers are paying them, that is the market's biggest fear right now. A hot services report validates the underlying inflationary strength that Powell is worried about. That would almost certainly push yields higher and stocks lower. Wednesday morning could be extremely choppy.
Okay, so navigating this perverse environment, this data vacuum, it means we have to look beyond just the S&P price. We need to focus on the inputs driving it. Let's identify the key strategic battlegrounds for the week. Starting with what you call the single most important variable for equities, the 10-year Treasury yield. Let's define its role as the market's leash. It closed last week around 4.09%.
Yeah, the 10-year yield is absolutely the key transmission mechanism for Fed policy right now, especially for stocks. And it operates through pure, cold mathematics. As we discussed, this current rally is being held up almost entirely by those mega-cap tech stocks. And how are those stocks valued? Not primarily on today's profits, but on massive future growth expected 5, 7, even 10 years down the line.
Right, the long-duration growth story.
Exactly. And these stocks are typically valued using a discounted cash flow model, a DCF model. That model uses the 10-year Treasury yield as the primary input for the risk-free rate component of the discount rate. Think of it simply. When you try to figure out the present value of, say, $100 you expect to get 10 years from now, you use the 10-year yield as the baseline measure of how much less that future money is worth today. It's the opportunity cost.
Okay, so when the 10-year yield goes up, the discount rate applied to those distant future cash flows also increases.
Precisely. And when that discount rate goes up, the present value of cash flows promised 5 or 10 years in the future gets aggressively discounted. It makes those growth stocks immediately less valuable today, right now. Since the big tech leaders rely so heavily on future growth rather than present profit, their current price-to-earnings multiples, their valuations, take the hardest hit when rates rise. This is the mathematical headwind. This fragile tech rally is fighting against rising yields.
Got it. So given that dynamic, why is the specific level of 4.25% such a critical line in the sand?
Well, 4.25% seems to be emerging as a key technical and psychological level. It appears to represent the sort of consensus median target yield for a lot of major investment banks, institutional funds, especially those algorithmic funds that trade based on fixed income and equity relationships. Crossing 4.25% seems to materially change the long-term discount rate calculation enough that it could trigger automated de-risking programs, selling programs.
Ah, the algorithms kick in.
Yeah, it's potentially the point where the pure mathematical pressure from the rising yield finally overcomes the momentum, the enthusiasm for the AI story. So, the actionable takeaway. If the 10-year yield stays contained, maybe below 4.1%, the bullish tech trend can probably survive, maybe even continue grinding higher. But if it decisively moves towards 4.25%, then you should expect the S&P 500's critical support level, we'll get to that next, to be tested almost immediately, as funds are forced to hedge or reduce their exposure to those rate-sensitive megacaps. Hashtag tagged 4.2 technical and volatility levels.
Okay, let's talk levels then. The S&P 500 closed Friday around 6,840. What are the key technical levels you're watching this week, especially thinking about that 4.25% yield trigger?
Right, the price action itself is technically constructive. The trend is still up. But because of that yield risk we just discussed, you have to watch the support levels very closely. The critical support level now seems to be the S&P 500's old highs from earlier in the year, that area around 6,750. That previous ceiling should now act as the new floor. A definitive break below 6,750 would be a significant negative technical signal. It would suggest that the mathematical headwind from the hawkish Fed and rising yields has finally overpowered the AI momentum, potentially forcing a broader technical correction.
Okay, 6,750 is the key support. What about resistance, the upside?
Well, the index is inching closer to that big, round, historic psychological target of 7,000. You often see significant institutional interest, sometimes short-selling interest, around those big, round numbers just due to human psychology and program trading. Beyond 7,000, the next technical upper resistance level, based on trend lines, looks to be somewhere near 7,075.
Now, you also flagged something interesting about volatility. The VIX, the volatility index, closed the week down at 17.44. Why is a VIX in the mid-17s a potential yellow flag right now, given all this fundamental uncertainty we've been talking about?
Yeah, the VIX measures implied fear in the market, basically the cost of options or insurance. And a level like 17.44 indicates a really notable lack of fear, especially relative to the environment we just laid out. We have a hawkish Fed, a data vacuum coming up, clear structural fragility in the market, this 4.25% yield level looming, yet the VIX is relatively low. It suggests dangerous complacency, yes. Investors seem to be operating with high confidence, despite these pretty severe looming risks. And what a low VIX level means practically is that it's essentially cheap fuel for volatility. Hedging is inexpensive right now. So if that 6,750 support level does fail, the resulting pullback probably won't be a slow grind lower. It could be sharp, fast, and rapid. Because when panic eventually hits, people will rush to buy that cheap protection, which spikes the VIX higher and actually accelerates the decline. Low VIX can paradoxically lead to faster sell-offs when sentiment finally shifts. Hashtag 4.3, the monetization lens earnings test.
All right, let's circle back to that new profit versus promise playbook we talked about with Amazon and Meta. The market's clearly showing it's unforgiving right now. And that lens, you said, is going to be applied mercilessly to some of the specialist tech firms reporting earnings this week. Which report do you see as the most critical test for this whole AI thesis?
Without a doubt, the single most important report of the week is Advanced Micro Devices, AMD. They report Tuesday after the closing bell. This is just a massive test. Why? Because AMD stock had a stunning run in October, up 58% in just 1 month.
58%.
Yes.
Wow.
Yeah, which means the bar for perfection is set incredibly, maybe impossibly high. Investors are absolutely going to judge AMD using that Amazon versus Meta playbook we discussed. Are they profiting from AI right now? Are they showing high gross margins? Are data center sales surging? Are they just spending heavily on future promises, like Meta's CapEx announcement that got punished?
So what specific metrics will they be looking for in AMD's report?
Scrutiny will be laser-focused on 2 things: their data center segment revenue and their gross margins. Analysts really want to see if AMD's latest AI chip, the MI300 series, is actually gaining meaningful traction against NVIDIA's H100 chip, which has been dominant. If AMD forecasts strong and critically profitable data center growth, let's say they beat analyst expectations, which are around 30% sequential growth that could validate the broader AI rally. But if they miss on revenue or if their margins look compressed because it's costing them a lot to scale up production, then the stock could see the same kind of violent rejection that Meta faced last week. Huge implications.
Okay, AMD is the big one Tuesday. You also mentioned Palantir as another key data point for this monetization thesis.
Yeah. Absolutely. Palantir, ticker PLTR, reports Monday after the bell. This is a really key test of the whole AI platform monetization idea. For years, Palantir was very heavily focused on big, bespoke government contracts. That was their bread and butter. Now the market needs to see clear evidence that their newer AI platform offering is actually translating into accelerating commercial contracts. That's seen as the higher margin, stickier part of the business. The options market is pricing in a massive move for Palantir, something like 17.8%, which just shows you the extreme volatility expected around this report. A strong beat on commercial customer acquisition numbers and stable or improving margins, that's probably the only thing that keeps the momentum going for that stock.
Got it. Beyond those specific AI plays, are there other earnings this week that act as broader economic bellwethers?
Yeah, a couple are worth watching. UBE reports, and that'll give us a necessary read on the gig economy and also consumer discretionary spending. That ties right back into the health of the labor market the Fed is watching. And we also get reports from major pharmaceutical companies like Pfizer, PFE, and Amgen, AMGN. They'll give us an update on the health of the entire healthcare sector. Healthcare is important because it often provides defensive ballast for the overall index if the more volatile tech sector falters. So their results matter for index stability too. Tag 4.4 commodity conflicts, gold and crude.
Okay, let's shift briefly away from stocks. How are the key risk assets outside of equities reacting? Thinking specifically about gold and crude oil in this new macro environment, the bookish Fed, the uncertainty.
Yeah, they're definitely reacting, but to slightly conflicting forces, especially gold. Let's start with gold. It closed Friday just hovering below that key psychological level of $4,000 an ounce, ended around $3,997.10. Now, the long-term bull case for gold, that remains pretty robust. Its historic surge earlier in 2025, when it hit a record over $4,300, really reflects its strategic long-term role. Central banks see it as crucial in what's clearly a more fractured global order.
Central banks are still buying.
Buying at record paces, actually. As a hedge against geopolitical instability, de-dollarization trends, that underlying bid is still there. However, in the short term, gold is facing a pretty significant headwind. And that headwind is driven directly by the Fed's hawkishness. Powell's rhetoric is fueling a U.S. dollar rally. And critically, it's driving real yields higher. That's the interest rate minus inflation. Since gold is a non-yielding asset, it doesn't pay interest when real yields rise, the opportunity cost of holding gold instead of, say, a treasury bond increases dramatically. That tends to push the gold price down in the immediate term. So gold is likely to remain under some pressure until the market gets more clarity on what the Fed's actually going to do in December.
Okay, so short-term pressure on gold. What about crude oil? Is the global growth outlook helping prices there?
Not really. The outlook for crude oil looks, frankly, unambiguously bearish right now, and the supply picture might be even worse than many realize. WTI prices, the U.S. benchmark, they fell back towards $60 a barrel last week, closed around $60.86. The drop is being driven mainly by massive oversupply concerns that just aren't going away. In fact, recent reports indicate that OPEC plus Bell, counterintuitively, might actually be inclined to raise production soon, or at least stop their deeper cuts. Why? Because global demand isn't growing as fast as they had hoped.
So supply is exceeding demand.
It seems that way, and critically, the source material points out that the volume of oil just sitting idly in tankers out at sea has apparently risen to a record high. That signals a persistent glut of oil that's struggling to find buyers right now. This bearishness isn't just market chatter either. It's corroborated by the official U.S. Energy Information Administration, the EIA. Their latest forecast is pretty stark. They expect prices to continue falling, averaging maybe $62 a barrel in this fourth quarter of 2025, and then dropping further to average just $52 a barrel in the first half of 2026. The supply side just seems to be overwhelming the current demand narrative for oil. Okay, so let's try to synthesize this incredibly complex picture we've painted. What we have is a market with a bullish trend that is technically sound. It's still pointing upwards, but that trend is fundamentally fragile. It's dangerously narrow in terms of which stocks are participating, and now it's fighting the direct mathematical headwind of rising treasury yields, which are being spurred on by newly hawkish-sounding Fed. You add in the complacency signal from the low VIX and the fundamental uncertainty from the data vacuum. It really feels like the perfect setup for maximum volatility in the week ahead.
Right. So to give you, our listeners, a clear strategic playbook for navigating these choppy waters over the next 5 days, we've boiled down all the source material we reviewed into 3 core actionable steps. Think of these as the key inputs you should probably track almost minute by minute. Actionable takeaway number 1. Watch the leash. That's the 10-year Treasury yield. This is your primary leading indicator for the stock market right now. If the yield stays contained, let's say below 4.1%, the tech rally might be able to keep breathing, maybe ignore the Fed for a bit longer. But if it decisively moves towards that 4.25% level, you absolutely must anticipate that the S&P 500's critical 6,750 support level will be tested almost immediately, as algorithms likely start to de-risk.
Couldn't agree more. Number one is yield.
Actionable takeaway number 2. Trade the perverse data. You have to prepare for potentially outsized, maybe even violent volatility around those key data releases and the ISM reports on Monday and Wednesday, and especially that ADP employment report on Wednesday morning. And crucially, remember the inverse logic. Strong economic data is likely bearish for stocks right now because it validates Powell's caution. Weak economic data is likely bullish for stocks because it forces the Fed's hand towards cutting rates in December. Plan your trades, set your stops accordingly. The reactions could be swift.
Yeah, that inverse logic is key this week.
Yeah. And actionable takeaway number 3. Apply the monetization lens. Don't treat all AI-related stocks equally anymore. Use that divergence we saw between Amazon, rewarded for profit, and Meta, punished for CapEx promises, as your playbook. Apply it directly to AMD on Tuesday and Palantir on Monday. If they prove tangible profit, if they show high gross margins, if they demonstrate accelerating commercial contracts, reward them. But if they simply promise future growth funded by big spending plans today, expect the market to punish them, potentially violently. Proof over promise is the name of the game.
That's it. Those are the 3 keys. Watch yields, trade the perverse data logic, and apply that monetization lens to earnings. And maybe I'll leave you with this final synthesizing thought because it kind of inverts the classic way we think about risk sometimes. The primary risk to this entire market structure right now, it's probably not a weak economy forcing a recession. Because, frankly, the Fed would likely react quickly to that with more rate cuts, which could support stocks. No, the primary risk right now seems to be a strong economy. A surprisingly hot ISM services report, maybe unexpected strength in the ADP jobs number, something that validates Chair Powell's hawkish stance. That's the scenario that could send the 10-year yield surging through 4.25%, breaking the back of this top-heavy equity rally and maybe triggering a sudden technical collapse. The biggest risk is good news.
Wow. The biggest risk is good economic news. That really is perverse, isn't it? And it's especially fascinating when you consider, as some reports noted last week, that one major tail risk, those U.S.-China trade tensions, actually seem to ease a bit, removing a potential negative catalyst. So given that bit of global Z-risking, but combined with the incredible narrowness of this rally that we keep talking about, should you trust the technical strength that's pushed us to record highs? Or is the market being dangerously complacent, as suggested by that low VIX level? Something for you to consider as you prepare for what looks like a challenging, but maybe also potentially lucrative week ahead in the markets. Thanks for diving deep with us on Bulls, Bears, and the Bell Weekend Edition. We'll see you next week.